The latest Commerce Department data reveals that in April, inflation reached its highest level in nearly 3 years, pushing the Federal Reserve's preferred price index up to 3.8%. Market analysts have been quick to blame the pump, pointing to the war-driven oil shock as the primary driver of these surging costs. The conflict has slowed Persian Gulf shipping to a trickle, choking off a vital waterway for the global trade of oil, natural gas, and fertilizer. Yet, while energy costs climb, Wall Street is focused on consumer spending, which powers 2/3 of the economy, noting a 0.5% increase for the month. This supposed strength has the Atlanta Fed projecting an annualized GDP growth of 4.3% for the second quarter, banking on the idea that the American consumer is holding firm. But look past the top-line spending growth, and the household math no longer adds up. If prices are soaring and paychecks are flat, that spending has to be coming from somewhere else. To understand where that money is coming from, we have to strip away the headline projections and look at the actual purchasing power of an average household. When we adjust that 0.5% spending increase for inflation, the actual growth in volume collapses to just 0.1%. Americans aren't actually bringing home more goods. Instead, they are simply forced to pay higher prices for basics like fuel, utilities, and groceries. While spending is being pushed higher by those prices, consumer incomes remained entirely flat for the month. Once you account for the rising cost of living, real disposable after-tax income actually dropped by 0.5%. The math is clear. Consumers are maintaining their pace of spending even as their take-home pay shrinks. This isn't a sign of a strong economy. It's a sign of a consumer under extreme duress. The gap between stagnant income and rising prices is being breached by one specific source: the personal savings account. The personal savings rate has just plummeted to 2.6%. This marks the lowest savings rate since June 2022 and represents one of the lowest levels recorded in the past 20 years. Earlier in the year, larger tax refunds provided a temporary financial cushion, but those funds have now been entirely exhausted. Relying on a dwindling piggy bank to absorb global economic shocks is a survival tactic that is mathematically unsustainable for lower and middle-class households. These depleted savings accounts are the missing variable in Wall Street's optimistic GDP projections. Forecasts anchoring on robust business investment and consumer momentum are currently resting on a rapidly crumbling financial foundation. Pressure is only increasing as underlying inflation climbs, driven by downstream shipping effects and new tariffs on a wide range of imported goods. Rising prices combined with exhausted savings will eventually reach a breaking point, forcing a severe and broad pullback in consumer spending. Geopolitical conflicts in the Middle East are driving the immediate price shocks, but the American savings account is the true long-term casualty of this crisis. Ignore the headlines and watch the consumer. When the savings finally run dry, the rest of the economy will follow. Stay sharp, stay informed, and I'll see you in the next one.